Welcome to the Financial Frontier. I'm your host, Patrick Camuso. Today I have with me the co-founder and COO of Cryptoworth, Richard Pasquin. I'm excited to have him here today. Cryptoworth is one of the leading digital asset subledgers for Web3 companies that help them get their accounting in order and get their financial reporting in order for audit purposes, decision-making purposes, as well as tax purposes. So today we're going to be discussing our experiences, both from myself at Camuso CPA and Richard at Cryptoworth, what we've been seeing in the trenches working with Web3 companies. There's a lot that we want to go over, including some specific questions that I have regarding audit readiness and how Cryptoworth can facilitate that for Web3 companies. So I'm excited to get into this talk here today. Richard, thanks for being here with me today.
Thank you for having me.
Yes, absolutely. So to get started, can you tell us a little bit about yourself, your company, and how you got into Web3?
Yeah, of course. My background is in international business. I got into Web3 early 2017, and that was really the wild west of crypto at that time. That's how I got into trading. I actually got into trading Bitcoin first, although I knew about Bitcoin for years prior, but haven't really delved into it until really that year. And I got into trading. I was heavily trading, and once I started reading more about the blockchain and I read the Bitcoin white paper, it not only became a hobby but a passion.
Absolutely. So yeah, we share a similar path in that regard. So I know you're working a lot with Web3 businesses to get their accounting systems in order. What is some advice that you would have for businesses that are looking to get involved in the world of digital assets, and for that matter as well for traditional CPA firms that maybe are looking to get involved in this world as well, and some of the nuances involved in that?
Oh yeah, so the advice I would strongly recommend for any business who wants to get into Web3 is to be prepared, plan it through. The crypto accounting reporting, companies that do a good job of this, they should be doing a preliminary research, a phase of research on how they're going to be expecting to handle the accounting side of things and the financial reporting side of things in crypto, because that is a major industry challenge. Because they're probably already meeting certain compliance requirements in their jurisdiction. They don't want to overstep their compliance by not being prepared.
Absolutely. Yeah, I totally agree on that point. Oftentimes, taxes and accounting can be somewhat of an afterthought when you're first getting involved into Web3, and understandably so, because there are so many competing interests for your time, attention, and resources when you're in the Web3 world, especially if you're a startup. But like you said, the taxes and accounting are a huge issue industry wide right now that we're both trying to solve. And it needs to be something that you're proactive about, because I'm sure you see this just as much as I do. There's a lot of companies that come with months, sometimes years of accounting that they haven't gotten addressed in the past, and they need to clean up before they can even get into a position of being into compliance. And then on top of that, dealing with some of the ambiguity with some of the transactions or digital assets that you might be dealing with, you want to also consider that proactively as well. So I completely agree with you there. The getting started earlier, the better, both in establishing an accounting system as well as your tax plan. So what are some of the common mistakes that you see businesses make when they're trying to put together an accounting system with a digital asset subledger and a general ledger? Is there any sort of consistent themes that you're seeing, or mistakes that you see either companies make or CPA firms make?
I think the common mistake is not knowing all the requirements ahead of time, because if you're choosing a Web3 finance stack, or if you're choosing a plan or a solution, let's say you're choosing a solution, there are some solutions out there. There's crypto tax solutions, crypto accounting solutions. If you're choosing a solution and you don't know your prerequisites beforehand, you're only going to find out once you're completely blocked with the wrong solution. That's why you need to know, okay, what accounting method are you going to use for your crypto assets? Are you going to use WAC, FIFO, LIFO, HIFO? Are you going to sync your journals into a main ledger, or are you going to use a crypto accounting solution as the main ledger? You need to know, okay, if you're choosing a solution, does it sync with NetSuite? Does it sync with QuickBooks, Xero? These are like common things that sometimes can be overlooked. But a prepared company will know exactly what they'll need. They'll have a plan in place. If they have a plan in place, most likely they're going to find the right solution for them.
Absolutely. I agree with you. Making sure you do that initial assessment both on what your company's needs are just at a basic level and what they're going to be in the future based off of the blockchain you're operating on, the types of transactions, how you want to set up your accounting system with the subledger and the general ledger. Like you said, there's many considerations and there's many different approaches that are out there, and you want to find the one that fits your company best. And what I see a lot of times is companies will just sort of get on whatever solution, I guess, first falls into their lap, however that may be. It may be through a referral or through a suggestion, but it is a commitment when you get onboarded onto a platform like Cryptoworth, and you want to make sure that it's going to be something long term in terms of all of the features and reporting and capabilities that they're providing. And Richard, I believe that's something that you're able to help people out with a lot in these preliminary phases, is being transparent with them on what your platform can do and who you guys serve best. And I think having conversations with you as well as with a CPA like Camuso CPA, and using both of these resources to help you arrive at a decision on what is the best software to select, because this is something that you're going to be using for years to come, and it's an investment in terms of the time that you're putting into these platforms. So I completely agree with you there. So how do you see the landscape of digital asset and taxation evolving in the coming years? Obviously, the regulatory landscape is sort of center stage here, even last year and as we move into this year. So how do you see that evolving, and what are some of the things that you're really sort of keeping top of mind?
Well, I foresee that it's going to be more commonplace that companies are utilizing blockchain to some extent, whether it's NFTs, just incorporating crypto assets. I think that on the retail side, it's going to be more common that the end users won't even realize that whatever product they're using online is using blockchain, even if it's some kind of even if it involves some kind of product that could be traded online. Like, for example, you purchase a product and there's an NFT associated with it. Maybe they're calling it something else, or making it easier to onboard into crypto on the retail side. And a lot of the time, companies will need to track these digital assets in their books. So we've seen already a lot of progress with the FASB ruling. At the end of this year, it's going to be the standard that companies will need to be reporting the fair market values for crypto assets. They did not include reporting standards for NFTs yet. I think that's going to be the obvious next step.
Yes.
Because NFTs have such a wide applicational purpose. So it's just going to be more commonplace in companies, I think, global, not just the US. So we're expecting that, and we're preparing by just increasing our reporting capabilities, blockchain tracking capabilities as well, so that all assets can consolidate in one system for companies and external accountants to have access to.
Absolutely. Yeah, I completely agree with you there. And I'm sure, this is a huge challenge at Cryptoworth and something that you guys are focused on because as the regulatory landscape continues to evolve and gain in complexity, so does the accounting and tax requirements. And then so does, the features and considerations that you have to take into account when you're building Cryptoworth. So the building, I believe, never really stops with a solution like Cryptoworth because the space is constantly evolving. So is there anything upcoming for your company? What's next? Are there any exciting future developments that are in the pipeline or specific new features or new sort of areas that you're focused on?
Yeah, sure. I'm very excited to share that we really recently launched our first version or beta version of our SAP tracking module. So if you want to think of what Cryptoworth is, we're not just a crypto subledger, we're a crypto financial OS or a crypto ERP for Web3 finance. So there's the crypto accounting piece, there's a crypto reporting piece, there's the crypto ARA piece, and now we just added a SAT tracking module. So for those of you who don't know, say it's a safe agreement, but with the token clause, or you can just call it token vesting. Really, from an accounting standpoint, it's tracking all the token vesting schedules. So that's another thing that we added to the module, to the platform, since we know that a lot of investors or venture capital that are investing in token projects, propping up a lot of Web3 investments in companies, they're tracking all these tokens manually on spreadsheets. So we're essentially adding another way of moving companies out of spreadsheets, but through a more investment, more of a venture capital and focus on that module.
Very nice. Yeah, I think that's a really interesting module because I do believe a lot of these companies are still keeping track of those vesting schedules, like you said, in spreadsheets and just basically providing PDF versions of that data to their employees. So I'm really interested to see that rollout and the response that you guys get from that because I think that's serving a huge need. So that's really interesting to hear. So are there any practical tips that you have for, let's say, a new Web3 business or a new Web3 CPA for keeping track of their crypto tax holdings for tax purposes that, beyond just sort of the basics of just like getting integrated into a ledger? Is there anything specific that you see go overlooked sort of in these initial stages, like maybe the first year of accounting for a Web3 business?
I think starting is the hardest part because I think a lot of companies, especially the finance teams, are overwhelmed trying to figuring out a new system completely by scratch. And some of these accountants are coming from Web2, so they might not have all the confidence to feel like whatever plan they set up would be the best one. So the 100% my recommendation for companies or people starting the Web3 finance stack for a company would be to consult a crypto specialized CPA. Number one, there's no it's really essential that the value that you would get from consulting a crypto specialized CPA or accounting firm is just immense because they're going to be able to, like for example, commercial CPA, you would be able to help the company, the Web3 finance team, figure out what's the best cost basis method they want to go forward with. Do they want to do a main ledger, sub ledger structure, just the crypto ledger being the main ledger, depending on how many of the transactions are on chain. Really, that's the best way to start. And before even looking for a solution, unless there's like a time urgency to have something in place just for the sake of generating a minimum level report. I would say start small first and start with consultation, and if you're gonna find a solution, start small, get the basic reporting needs that you need to file, and then go from there. So I would recommend companies to just, don't try to do everything at once. It's going to get messy. Try and figure out what you absolutely need and try and get that first, and then move on from there, expand from there.
I absolutely agree with that. And a methodical approach, like you outlined, is key because you want to get your system set up properly and maintained properly, because any errors that you make are going to cause accounting and tax issues that you have to unwind for that current tax year, but also it could even impact future tax years because there's a cumulative nature to tracking your cost basis in all of these digital assets, and that's going to also affect your balance sheet account. So like Richard is saying, you don't want to just sort of dive into something and just move forward and just sort of get some halfway solution. You want to take a systematic approach to getting accuracy the first time, because a lot of times what I see is companies that don't take a methodical approach end up having to sometimes rework a lot of work that we've seen done, either from them just self-managing or from working with a CPA firm that maybe isn't as well versed in crypto. So you have to get things set up correctly, because there's a lot of errors and issues that you could quickly have to unwind if you don't take that methodical approach like Richard was saying. So Richard, I know another area that you're focused on working a lot with companies is audit readiness. So what are some of the key challenges that you see Web3 companies facing with audit readiness, and how are you helping solve some of those challenges at Cryptoworth?
Yeah, sure. So I would say the best way to be audit ready for a Web3 operation is to compare what the calculated balances are versus what the reported balances are from the blockchain. So if the calculated balances in your ledger are 1-to-1 with the balances reported on the blockchain, and you can cross-check Explorer. So that's what a lot of people would do manually, is they would cross-check Explorers. Of course, the more chains the company's on, the more Explorers they have to deal with. And some of these Explorers are completely different, so it's harder to read some of the data on some of these Explorers. So that's how we approach it. In Cryptoworth, we have a sophisticated sanity check report that automatically calculates the calculated balances in the ledger versus the reported balances. If they're not matching, most likely it's going to be the calculated balances not matching the reported balances. Mm-hmm. That is going to be the telltale sign that the ledger is not, in fact, reconciled. So we're essentially expanding on that, the ability to detect when the ledger is not reconciled. So we have multiple systems in place to help accountants, like whenever there's inventory deviations or no market price deviations for certain transaction events, because not every token has fair market values, and some chains are different than others, and it also depends on the type of activity the company's doing. If they're on DeFi and they're sending assets away from their wallets, but they still own those balances should still be reported in their balance sheet, even though if you just check on chain, the balances wouldn't show up in that specific wallet unless you're looking at some kind of DeFi tool. So there's multiple factors to consider depending on the activity of the company. So the best way would be to determine what the activity is first of the company, and then you can easily figure out, okay, what's the best way to make sure they can take an audit-friendly approach with the right reporting structure in place.
Absolutely, I 100% agree with that. That's one of the big things that we focus on at Camuso CPA, and that even in my content that I focus on as well, is comparing your calculated ending balances to your actual ending balances, like you said, that are reported on the blockchain. I think it's great Cryptoworth has that feature that is embedded in the software to do those comparisons, because it does cut down on some of the back and forth and input that we'll either have to get from the client or just from searching various block explorers, like you said. But this is something that I think, has been going overlooked by companies and by firms for years now, because it's one of like the common themes that I've been seeing, particularly for 2023, is companies coming to us and their calculated ending balances have obvious discrepancies that apparently were never really reviewed or addressed. And like I was saying, that can cause issues where, overstated or understated balances, it's going to cause discrepancies in the current year, but also that's going to carry forward into future years as well. So it's crucial to do that check. And yeah, I believe that is one of the most important final checks for accuracy. So I think that's fantastic. So what are your thoughts on sort of the future of audit tools in the Web3 space? And what approach do you think that regulators are going to take in terms of how, they're going to leverage these tools and utilize them as well? Because obviously, if they're going to be doing audits, they're going to have to take this into consideration as well.
Well, what we've seen auditors do with the companies that use Cryptoworth is they'll come into the ledger, the Cryptoworth ledger of the company that's being audited, and they'll select a few random transactions from their ledger, and then just cross-check it with the blockchain to see if whatever was recorded in their ledger is accurate based on what's on chain. I think that is I think that's quite the norm right now, but what I believe will happen in the future as auditors get more and more used to auditing different blockchains and seeing common like crypto subledgers, crypto accounting softwares, and as the space matures, I think there's going to be more comprehensive Web3 specific audit tools that either regulators are going to build or utilize to have a more efficient way, I guess in their perspective, a faster way of conducting these audits, because early on it was very complicated for them. They weren't even sure. When we were seeing some of these auditors, they weren't even sure how to conduct the audits. That was like the early problem we were seeing in the space. Now they're starting to know how to do it. They're going to the company's ledger, whatever ledger they're using, and even this can even include spreadsheet, right? But a lot of the time we've seen those companies fail those audits. And that's actually one of the reasons why they come to Cryptoworth, is because it failed that way.
Yes.
But I think auditors will just take it as a common practice to go into a crypto ledger to cross-check and make sure that whatever they're reporting is correct. And the crypto subledgers or crypto accounting solutions that out there that are not reporting correctly are going to be quite penalized, because of course in the end it's the company's audit is at stake.
Absolutely. And is there any current or future plans for Cryptoworth to also partner either as a contractor or in any other capacity with regulators such as state taxing agencies, or focusing more specifically on working with auditors? Is that on the horizon for you guys? I know at least here in the States, the IRS has been looking, at like proposals from solutions like yourself to help sort of facilitate some of the auditing and the data processing. So what's your perspective on that?
So there's it's a different type of business model to focus on the tax authorities, because our goal is to make sure that Web3 companies and Web2 companies getting into Web3 are reporting accurately. They're compliant, and basically merging the blockchain world into the financial data world. or financial accounting world, serving auditors directly would not be the same. It wouldn't be like exactly the same product. They wouldn't use exactly the same product, but rather they would use it for a completely different use case, right? Just to track if someone else is, or if another entity is reporting correctly. So it would be more like, um, I guess, similar to like Cipher Trace or uh, Chainalysis. Those two companies really focus on tax authorities,
And have some partnerships
government
with
agencies.
them, I believe.
Right.
Yeah.
We do have early conversations with some tax authorities regarding the accuracy of capital gain loss reporting for entities. I think it's still very early for the tax authorities to commit to like a specific solution right now. I think they're trying to wait for the market to mature before they do that. But that's why they're seeing proposals now. They've been pretty open with proposals for quite some time now. I think they're trying to see where the market's at.
Yeah, I believe so. I believe so. It's interesting to see, like you said, it's early days, so it's really sort of watching that develop from the start. But yeah, I can understand the approach is a lot different from where you guys are focused now to working with the regulators. But it's interesting to see how they're dipping their feet in the space, and sort of is contrary to the widely held opinion that the regulators don't know anything about crypto, because they are speaking with a lot of the solution providers out there, a lot of tax professionals out there, and monitoring and wrapping their head around the space. So what are some of the key takeaways or lessons that you've learned working with Web3 companies in terms of audit readiness? Is there anything else that you want to impart from them to them in terms of things that they need to consider to ensure that they, if audited, they are successful?
Yeah, a few tips. I would say if you're looking into a potential solution, test it uh, before you buy it, because implementation can be, you may hear a solution say, "Oh, we'll build it," and then 6 months later, you're over deadline and it's still not working properly. So make sure you know your requirements ahead of time. Uh, the next tip I would say is, don't wait until the last minute. We've seen this happen too much. Fortunately, companies will focus on the fiat side of things first, and just completely neglect the crypto side of the books that they have, but they have an audit for, and they're like a week away from deadline. This happens all the time. We'll get a company in, and they will say, "Oh, their deadline is like next week," uh, and there's like no time to onboard.
Yeah.
And not only that, but they'll say, we're backed up all the way through 2019. We didn't. We have to do 2019 all the way to the present one.
Yeah.
Our deadline is next week.
And that goes to
So
that cumulative nature of tracking. So if you've left years of your accounting off, you're going to have to catch up to get to that current year, whether it's for tax reporting or for audit purposes. So yeah, so that is a common thing that I see too, is people waiting till the last minute. And also, would you agree that a lot of times people underestimate the time and effort that goes into managing a subledger and properly categorizing and reconciling the transactions? Because due to the complexity and the nature of how a lot of the data comes from the blockchain into the subledgers, there is a reconciliation process and a due diligence process, like we were talking about, and that simply is not going to be completed in a week or two's time, even though that's what some people come, I believe, to both of our companies hopeful for sometimes, especially if there's a tax deadline or an audit looming. So would you agree with that? Sometimes people underestimate the effort and time that goes into properly reconciling their digital asset activity.
absolutely, I fully agree. I think a lot of companies will just focus entirely on the product, collect all this revenue or investment in tokens or crypto, even NFTs, and they will just wait until the very last minute to do it because they think it's going to be maybe a week or two. But just onboarding could be a week or two at the fastest onto a new accounting solution, let alone reconciling everything. We've heard of some solutions that will take up to 3 months to implement. So it really depends on the solution that you're exploring as well. Um, and what the business activity is. So if you're a DeFi protocol, your transactions are most likely going to be more complex than a firm who's trading on a few exchanges,
Absolutely.
uh, or an NFT project that is on multiple marketplaces, and some entities have fair market value, some don't. So the ones that don't, they still have to be reconciled, right? So
Exactly.
we need, they need to have a cost basis. The receiving end and sending end, there needs to be sales or proceeds.
Absolutely. Yep. All those transactions need to be reconciled, and it is a process. And once you even get past the onboarding and just the categorization, then you get to that reconciliation, comparing actual to calculated holdings, and that can become its own rabbit hole of uncovering wallets that were not originally included, or just data that needs to get adjusted for other reasons. So, that whole process can take time as well. So if there's one piece of advice we both can give, is don't underestimate the time investment that goes into accounting for your digital assets, and make sure that you're proactive in this whole process. So Richard, one more thing that I'm interested in, and that's just a hot topic just all around, is emerging technologies of artificial intelligence and obviously blockchain. So we're involved on the blockchain side, and artificial intelligence, I think, can impact the blockchain industry as a whole, but specifically the accounting and tax industry. So like, what is your perspective on that? Do you see AI features or AI capabilities getting integrated with Cryptoworth, either in the short term or the long term? And how do you see that getting integrated, and where do you really see that helping accountants and companies in their accounting?
Yeah, we actually, it's funny that you asked. We actually are in the process of integrating ChatGPT into Cryptoworth. So we're
Nice.
actually utilizing AI to make it easier to figure out when there's deviations. That this is going to be a hot new feature that's going to come out soon. So helping users calculate if there's the rolling inventory, or if there's a inventory deviation, how much does the balance go negative on that deviation, which would otherwise be calculated manually. We're going to utilize AI to make it much faster for accountants to just be supported on the platform for questions that wouldn't go to, for example, an account manager.
Absolutely. Yeah, no, that's really interesting. Starting to streamline some of the due diligence and clearing up some of those basic issues. That sounds really interesting. So glad to hear you guys are focusing on that, and I'm excited to see those features roll out. Well, Richard, is there anything that we didn't discuss today that you think is important for Web3 CEOs, Web3 CPAs, Web3 CFOs to understand when it comes to Cryptoworth, or just audit readiness, or digital asset accounting in general for Web3 companies?
No, I think the only thing I would say is, if you're a Web3 company out there, or you're a Web2 company looking to get into Web3, don't be overwhelmed. Look for your requirements, your basic requirements at a minimum. Um, Look at consultation if you need it, whether it's outsourced bookkeeping, or a fractional CFO, or just crypto specialized accounting consultation help that you need. And for your crypto accounting solution, look for a solution like Cryptoworth, for example, that may have your chain supported. For example, you want to make sure your chains are supported. The ERP that you're going to sync journal entries to, if you're going to sync journal entries to another software, is supported. Your accounting method should be supported, and make sure you have a strong idea of the any implementation time and onboarding time of whatever solution that you're going to go with.
Absolutely. No, those are great tips, and I really appreciate that, and I agree with every one of them. So, Richard, I really appreciate your time here today. You gave us a lot of great information just in terms of tips that Web3 companies and CFOs can go and use right now if they're setting up an accounting system, as well as some really interesting features and value that you're providing at Cryptoworth. So, how can listeners connect with you and your company if they want to learn more about working with Cryptoworth or just get connected directly with you?
The best way to get connected with me would be on LinkedIn um, or on Twitter. I'm also on Twitter. If you want to get connected to Cryptoworth on our website, you can contact our team directly. You can even book a call directly from our website if you're just even if you're doing preliminary research on what your accounting stack is going to look like. Um, those are the ways you can reach us.
Fantastic. So everybody heard that. If you want to speak directly with the team at Cryptoworth, go to their website and you can contact them directly via their form submission or just calling them directly, or you can connect with Richard directly on LinkedIn. Richard, I think that's maybe how we got connected. But it's always great working with your team at Cryptoworth. You guys are very professional, very responsive. So again, I appreciate having you on the Financial Frontier today. We'll be posting this show across LinkedIn, Twitter, all the podcast platforms, as well as our website at thefinancialfrontier.com. So to all of our listeners, thank you very much for listening today. I hope you gained value from this. Until next time, I'm Patrick Camuso, signing off.
Thank you, Patrick.
Thank you.